Let me now turn to inflation. Headline inflation edged up to 5.1% in June 2024 due to higher than expected food inflation. Fuel remained in deflation for the 10th consecutive month. Core inflation moderated to a historic low in the months of May and June. Food inflation, which has a weight of around 46% in the CPI basket, contributed to more than 75% of headline inflation in May and June. Vegetable prices increased sharply and contributed to about 35% to inflation in June. High inflation pressures persisted across other major food items also, details of which are given in the footnote. On the other hand, the softening in core inflation continues to be broad-based, with core services inflation touching a new low in the current CPI series during the month of May and June 2024. The high food price momentum is likely to have continued in the month of July also. Large favorable base effects, as I said earlier, may however push headline inflation downwards in July. The impact of the revision in milk prices and mobile tariffs also needs to be carefully monitored. A degree of relief in food inflation is expected from the pickup in southwest monsoon and the healthy progress in Kharif sowing. Buffer stocks of cereals continue to be above the norms. Global food prices showed signs of easing in the month of July after registering increase since March 2024. Assuming a normal monsoon and taking into account the 4.9% inflation print which has already come out so far as Q1 is concerned, CPI inflation for the current financial year, that is 2024-25, is projected at 4.5%, with Q2 at 4.4%, Q3 at 4.7%, and Q4 at 4.3%. CPI inflation for the first quarter of next financial year, that is Q1 2025-26, is projected at 4.4%. The risks are evenly balanced. Now, I have given a brief analysis of the growth scenario and also the inflation scenario so far as Indian economy is concerned. Now the question arises, what do these inflation and growth conditions mean so far as monetary policy is concerned? Let me try and answer. As stated earlier, continuing food price shocks slowed the process of disinflation in Q1 2024-25. There is also considerable divergence between headline and core inflation. This has brought to the fore the issue of how much importance should the MPC give to food inflation. Let me dwell upon this in some detail. First and foremost is the fact that our target is the headline inflation, where food inflation has a weight of about 46%. With this high share of food in the consumption basket, food inflation pressures cannot be ignored. Further, public at large understands inflation more in terms of food inflation than the other components of headline inflation. Therefore, we cannot and should not become complacent merely because core inflation has fallen considerably. Second, and equally important, is the reality that high food inflation adversely affects household inflation expectations, which have a significant impact on future trajectory of inflation. Household inflation expectations, after witnessing a moderating trend between May 2022 and September 2023, have edged up on the back of high food inflation since November 2023. Persistently high food inflation and unanchored inflation expectations, if they materialize, could lead to spillovers to core inflation through pickup in wages on cost of living considerations. This in turn could be passed on by firms in the form of higher prices for services as well as goods, especially in a scenario of strong aggregate demand. Third, these behavioral changes can then result in overall inflation becoming sticky even after food inflation recedes. The MPC, to summarize, what these points which I was mentioning about the importance of food inflation and how high persistent food inflation can spill over to core and to the headline. Let me just summarize this part by saying that the MPC may look through high food inflation if it is transitory. But in an environment of persisting high food inflation, as we are experiencing now, the MPC cannot afford to do so. It has to remain vigilant to prevent spillovers or second-round effects from persistent food inflation and preserve the gains made so far in monetary policy credibility. Now, overall, as I have said in my statement and as the numbers would speak, overall the inflation trajectory has been moderating and we do expect it to moderate. But the pace of moderation has been uneven and slow. So therefore, we need to be watchful to ensure that we move to closer to 4% and the CPI inflation gets aligned to the 4% target on a durable basis. That indeed would be what I should say, that it indeed would be the best contribution which monetary policy can make to support economic growth in the country.